Hello, everyone. Welcome to the first interview session of what I know is going to be a brilliant couple of days discussing the future of private investing. As we're all aware, investors face a multitude of challenges, from the impact of Russia's war in Ukraine to the ongoing ramifications of the COVID-19 pandemic. Geopolitics in many parts of the world is fractious, but we might remain optimistic about human ingenuity and our collective ability to adapt. To help us navigate the challenges and opportunities investors face, I'm absolutely delighted to be joined by Mary Buffett. Mary is a best-selling author, international speaker, entrepreneur, political and environmental activist. Her first book, Buffettology, co-written with David Clark in 1997, was an immediate New York Times and Businessweek bestseller, and her subsequent 6 books have all been bestsellers too. Mary is also the former daughter-in-law of legendary Warren Buffett. Mary, thank you for joining me. How are you?
Thank you. I'm fine. Thank you for the lovely introduction.
Well, as this is the opening session, I'm going to start with a broad question. How optimistic are you about the current investment outlook? On the one hand, there are lots of challenges from inflation, fears of a recession, huge global debt levels. On the other hand, valuations are much more compelling in many parts of the market than they were 6 months ago. So what's your current outlook?
I'm pretty positive about it. There's always problems. There's always some issue related to our economy, to what's going on worldwide, etc. So nothing is that particularly compelling. Um, it's just as always, it's a good time to do your research, to really look at the companies that you want to invest in. Maybe take a little more time because it is an interesting time to invest now because, as you said, things are fluctuating around a little bit, but um, you're always thinking well over the long term. I just realized I was thinking about this show yesterday, and I was like, I remember when I first started investing in the early 80s when I was married to Peter, and I think it was over the first Christmas when I really found out, what his father did. And at that time, Warren was not in the news. People weren't talking about Warren Buffett like they are today. But I just knew that he was investing in companies. And I think one of the first companies after that I invested in, which I still have to date, was Coca-Cola. And then after that, years after that, he would give us a or a Christmas present each year. And at first, he used to just give us cash, $10,000. And when he realized that we were spending it, he started giving us stock in companies that he recently bought because he realized that would be a little more difficult. We'd have to sell the stock, get the cash, then use the cash. But that was incredibly interesting to me. And when I really started to think about investing in the stock market, in companies, because that's what you're investing in, you're investing in companies. So, I just can't tell people how important it is to really look at the companies you're investing in. First of all, try to make sure you understand what you're investing in. I mean, Warren always says he only invests in companies that he understands what they're doing. And that's why he usually invests in things like soft drinks and cocoa and candy, and because that's what he eats. But um, yeah, I mean, I think it's really important for us to, as investors, to do the homework. Yeah.
That's very good advice. We've had quite a lot of questions in ahead of this event, and lots of people are asking about inflation. And I know that Warren Buffett himself has said that inflation swindles everybody. Businesses with high margins and pricing power are often touted as those that are likely to protect against inflation. Do you have any more guidance on specific types of businesses, examples of what sectors that they're in that you think will do best if inflation persists?
Not necessarily. I mean, I always think industries like the banking industry it's not going anywhere. I mean, this is going to be around. It's just a matter of finding the right bank. Excuse me. Oh, that you want to invest in. So it's good to look at them, Wells Fargo, Bank of America, to name a couple, and look at the history of them, what their earnings have been, what you can anticipate their earnings are going to be in the future based on their past earnings, because that's generally a typical good indicator. And project out what they're going to be doing in 10 years, because the minimum time I'm going to make an investment and hold it is 10 years. That's minimum. It's more like 30. I mean, I was just thinking this morning before this call, gosh, I invested in Coca-Cola back in the 80s. And I think of the 80s as just like, you know, yesterday, but it's 90s, 2000, 2010. I can't believe it's over 30 years ago. So those investments that I made in the 80s, I've held on to for 30 years.
Yeah, and it's interesting that you mentioned banking there, because I know that Warren's been more active this year than he has been for a while, and banking and financial services companies. He's added three names, I think, this year, and he's also added to the energy sector. What's your view on the outlook for energy, and also any comment on the types of companies that he's been buying this year?
I don't usually comment on the companies that he's buying because those are very specific to Warren, and that's the interesting part. And that's what any one of the investors should be doing. They should be specific to you. Once again, only investing in companies that you understand their products, their services, that you look at their management. I really think it's important, and I don't think people do it enough, but to look at companies from a financial perspective and a management perspective. So you really kind of not only understand the business, but you understand the management and where they're going with the business, because that's a crucial part of a business's future. And that's the reason that Warren puts so much emphasis on, buying a company that he keeps management in place because it's excellent, because it's good. It's doing the right thing for the shareholders. It's doing the right thing for the company, not putting a bunch of money into the CEO's pockets, for instance. So that's an important thing to look at in a company, any company that you're investing in. It's great to read the annual reports and look at what they've done over the last 10 years and figure out what they're projecting for the future is. And you can invest slowly in it or wait for the market corrections for their stock to be a little bit lower than their actual value is. Figure out what their actual value is. I mean, that's important to know so that you can hopefully buy undervalued. That's the whole idea of value investors, is we like to buy companies under their value and then hold on to them for a long period of time, because they'll eventually reach their value and go above what their value is today. Mm-hmm. Really important to do the research.
Yeah, absolutely. One of the discussion points for this interview was talking about the trends that are likely to endure. Clearly, we're in the middle of an energy transition, and there's a debate over how long this will take, and fossil fuels have delivered strong returns this year. Do you have any guidance on what part of the energy transition you think investors should be looking at?
I really don't in particular. I mean, of course, we want to look for energy sources other than oil-based, sources. So alternative energy sources, I think, are going to be and continue to be a big thing. So I think that's where we're going for the future. We're not looking at using more oil. We're looking at using less oil and alternative energy sources, the sun, the wind, anything. And I think that's where we're going. I mean, we're in the green room, so that says it all. We're all about the green space, and this is where everyone's, compared to 10 years ago when a lot of people weren't into green energy, unbelievably. It's becoming more prevalent now, and I think that those companies that are involved in it are getting more popular and more attention.
Yeah. And you mentioned valuations earlier, and as value investors, you really don't want to pay too much for a company. Now, tech and also the energy transition technology is another big trend, turbocharged by the pandemic. Stocks went up enormously, and now we've had some quite big price falls. The Nasdaq's down 25% this year. What type of companies do you think have the best prospects in tech, and how can investors understand when the ratings, the valuations become reasonable and it's time to go back in again?
Oh, what companies in tech? Interesting. I think companies that I'm trying to think of one in particular, a couple, but companies that have technology that's based in communications. I mean, look at Zoom, for instance. Look at all the things that we're using right now for this interview. Those things are not going away. As a matter of fact, more and more with pandemics and the likeliness of all of those things, we're not meeting people. We're doing things over the internet. We're doing things more and more on telecommunications. So I think those are really interesting areas, but difficult to always decide which ones are going to be around. I, you know, I just think it's the old adage of buy what you know. I may be very into Zoom, other people may not be. Other things, just again, it's what we know. I mean, I'm trying to think. I know a lot about banking, so I'm interested in finance and bank stocks and so on, financial stocks. But that's because it's my business. If I was interested in, like my son, who's interested in cooking, and there's a whole other side. So whatever you're interested in, I think is the place to look for. So you're comfortable with what you're investing in, and you look at the companies, you do that research. I mean, that research is just critical so that you can look at, especially it's what their earnings have been, over a long period of time. So you're going to invest for a long period of time. So you want to look at companies where you can actually look back, I said at least 10 years, and see what their trend has been. Have their earnings been, slowly going like this, or have they been up one moment and down the next year? You want something that obviously has this slow growth, going up. Yeah.
And where do you sit on the value and growth spectrum? I know it's a slightly blunt instrument, but there are people that think that growth might have bottomed out now and that's the place to be, whereas other people think that value stocks, might lead the way for the next 5 years. Do you have a preference? I'm guessing from your preference for bank stocks, maybe on the value side. Would be interested to hear what you think about that.
Yeah, yeah, definitely the value side. Yeah. I mean,
Now,
it's more comfortable for me. Yeah.
yeah, yeah,
And
and
that's it. You have to be comfortable in what you're buying. A lot of people, don't listen. Your stockbroker only makes money when you buy and sell stocks. Just remember that. He's not interested in a client that's in it for the long run because he doesn't make any commissions. If you're buying something and holding on to it for 30 years and you're not selling anything, he doesn't make any money. So I don't take, I think that stockbrokers' opinions and their suggestions are very much couched in the fact that they make money on sales. So I think you have to really, if you're going to invest in a company, do the research. You do take some time. It's your hard-earned money. And a lot of people I know, they'll listen to a stockbroker, they'll listen to a friend, they'll go out, they'll invest without really taking the time to look at the company, look at the management, look at what the earnings have been over a long period of time. Because you want to invest for a long period of time, because that's when the compounding interest pays off for you over a long period of time. Just think about compounding interest is an incredible tool. Just think about a dollar. If it compounds at 100%, it's $1 this year, it's $2 next year, 4, 8, 16. It's incredible. That's 100%. But generally speaking, you're going to get compounding interest rates anywhere from 6 to 12%. Obviously you'd like to get above 8%, but that's very good for the long
Yeah.
term.
ESG investing, environmental, social, and governance investing, has come under a lot of criticism this year. We've had Elon Musk calling it a scam and others referring to it as woke capitalism. What are your thoughts on ESG and how important these metrics are for investors in their financial returns?
Well, I think it's something that we always have to consider. I think that you have to think about a number of things when you're investing, and this is one. Certainly environmental causes and environmental awareness is growing, and I think that it's a great space to look at for the future, because that's what's going on with the future. Environmentally, uh, environmental companies and what they're doing. I mean, it's becoming more and more prevalent in our lives. And so I think it's an important part of investing, hmm something that we have to consider. So companies that
And
are involved in environmental investing, companies that are generally environmental companies, I think we have to look at now as a way to the future.
yeah, I agree. And there could be a sort of wave of litigation even coming for companies that are
Right,
not doing as they should in this area. Um,
right.
we've talked a lot about valuing companies, make sure you understand it, make sure you pay the right price for it. Do you, as the world changes, do you think the best way to value companies changes? Perhaps you could draw on any examples that there might be from Warren Buffett or Keith Ashworth Lord, who you've let use the Buffettology brand for his funds.
What was the question? Can I think of?
Is the best way to value companies changing, or what type of metrics we should look at changing? Because companies now in lots of cases have much more intangible assets which maybe aren't captured by traditional valuation metrics.
Um, I think you really have to immerse yourself in any company that you're thinking about investing in, and do as much research as you can. And whether that's calling the company, looking up the company's the company's balance sheet, looking up the management. Management is very important. I think I've said it before, but it's part of one of the things that Warren really looks at with companies, because the management who has the shareholders' interest in mind is really the kind of management we want, rather than management who has their own interests in mind. So you're not looking for management of a company who's, the chairman of the board is taking an enormous amount of salary, or anybody. So you have to kind of look at all of that to see what the management is really doing with the money. What are their plans for the future? And that's a matter of, reading their annual reports. A lot of times, companies' management will put out they'll write something about what their plans are, or how they feel about the company. And that's really important. So the more you can know about a company, including their management, including looking at their financial well-being, looking back on what they've been doing for 10 years, what they're projected to do for the next 10 years. This is really important, more important than someone like a stockbroker or anyone telling you what to invest in. You've got to really know that yourself. You've got to know what you're familiar with. I'm familiar with financial stocks, so banks are really interesting to me. Financial institutions are interesting to me, but someone else might be in the food industry, and there's plenty of companies that deal with that, or pharmaceuticals. It depends on what you really know and understand. So always invest in what you know.
In today's era of high valuations, rising interest rates, and low expected returns, do you think retail investors should maybe move out of index investing?
It's very personal. It's very individual. It's really about what you understand, and uh, you have to be comfortable in what you're investing in. I mean, this is the part of the problem is, a lot of people listen to stockbrokers, a lot of people listen to friends. If I say, oh, you should invest in this, some people I know will just invest in it. They won't do the research. To me, it's always good to do your research. Look up the different companies, look at who their management is, what they've done in the past, what they're planning on doing in the future. Really do the research. There is so much research, more than most people understand, if you just start looking for it. you know um, Generally speaking, CEOs and presidents of companies and so on often they send letters, they put out announcements and so on as to what they're doing and what they're thinking. And it's really good for you to know. And it's also good to know what the managers' mindsets are, what the managers are doing, what they're likely to do with profits. Are they going to buy back shares at a cheaper price? Are they going to invest in new businesses? It's really important to understand what the managers are doing in the individual companies. So, as much research as you can do, the better, because you want to understand. You have to understand before you invest. So, taking someone's opinion, or even your stockbroker's opinion, why is the stockbroker telling you to invest in this company? You have to question that. So, you should only be investing in things, number one, that you understand. Number two, hopefully it's below the market value, or understand what the market value of the stock really is. And to do that, you have to look at a number of things. You have to look at the company, look at what it's done in the past, look at what their earnings have been. Have they been consistently going up over the years? Not an enormous amount, because you don't want something that's going way up one year and then the next year not making any money. You want a company that slowly over time, earnings are steady, earnings are going up, because again, I'm buying things and holding them for, I just realized the 80s is 30 years ago, and I still have things I invested in the 80s, like Coca-Cola. And it's only gotten better and better.
Now, you've had the privilege of getting to know Warren Buffett personally. How would you describe his personality, and what do you think it is about him that has made him so successful?
Wow. Well, he's incredibly focused. And one of the things I think that Warren does, which a lot of people don't do, is he does an enormous amount of research. In other words, when he looks at a company that he's investing in, number one, typically he understands what the company does, and that's really important. I'm not going to buy a pharmaceutical company because I don't understand pharmaceuticals per se. Um, but so you have to kind of understand what the company does and then look at the management, look at what their earnings have been. Are they going to continue to grow? Uh, what is your what is your calculated investment, decisions, like what what don't you want, what do you want? You want a company that hopefully is growing over a period of time, because if it's grown over 10 years, it's probably going to continue to grow. So you don't want companies that have these enormous earnings one year and the next year none. And you want something that's continually growing so that you can, it's more predictable. So over the next 10 to 20 to 30 years. Like I said, I have stocks that I bought in the 80s that I still have. 80s, 90s, 2000, 2010. It's 30 years or more. It's really a long time. I mean, a lot of people, they make investments and they're in and out of investments over short periods of time. And that's definitely not what I'm interested in. I'm looking at companies, I'm reading about them, I'm looking at their management. What is their management planning on doing? This is very important for you as an investor to understand. Because for like me, I'm going to hold something for a long period of time because,
Yeah.
hopefully it will be worth much more.
I'm afraid we've only got time for one more question. The UK, the SDL UK Buffettology Fund that Keith Ashworth Lord runs, and you know him well, I believe. It's
Oh, yeah.
it's got a very good long-term performance, but it's in the fourth quarter in its sector over the last 1 and 3 years. So I wondered what type of time you think, because lots of us invest via funds rather than companies. I wonder what time frame you think fund managers should be judged on, and how you should assess what type of fund you might want to invest in.
Well, I would say, I'm going to look at a fund manager's performance at least over a 10-year period of time, minimum. What have they done in the last 10 years? Typically, then you're looking at what they're going to do in the next 10 years. So you want someone who's not volatile. You want someone who can sit and wait for a stock price on a certain company or you know, uh, area of whether it's banking or whether it's pharmaceuticals or whatever it is. You want to know that they really have the knowledge in those areas, and look at what they've done. I mean, the past performance is generally going to tell you what their future performance is going to be. Do they hold for the long term? Do they buy for the long term? And that's really what you want, so that they're not necessarily, they may not buy anything in this year. So that's not a bad thing, as long as they bought in the past and it's continuing to grow. That's the main thing. Mhm. Does that
Great. Well,
answer your?
thank you so much. Thank you so much, Mary. I'm afraid we're out of time, but really appreciate having you on. That was
My
really
pleasure.
interesting.
Thank
I'm
you.
now going to hand over to my colleague Mitchell for the session on profiting from property in a post pandemic world. Where do the biggest opportunities lie? Thank you.